Hi, everyone. Thanks very much for joining today. I know that you've just come off another webinar, but I'm here for the London Open Breakfast. I would like to just welcome you all. Now, just bear with me. I'm just going to do a quick video check just to make sure my screens are working. Now, you should be able to see my gold Bloomberg chart there. I assume you can. Give you a little taste of what we'll be doing. Excellent. So it looks like you can. So just bear with me one moment. Great. So it looks like sound and video is all good. So let's get going. First things first, I'm just going to go through kind of the main things that are really driving sentiment today. Yes, European stock markets have opened lower today, which is no surprise. We have this toxic mix out there right now, which is very weak growth from China. So we saw their PMI, so their Purchasing Managers Index, which is a really good proxy for GDP and for overall growth in the economy, actually dipped to its lowest level in 32 months and is in contraction territory, which is really worrying. Combine that with weaker GDP, a second revision of Q3 GDP, which was weaker than expected out of the US, and add to that the ongoing Eurozone debt crisis. Just from a fundamental perspective, that is very much a toxic mix for risk. So that's what we're dealing with on a fundamental level. Now I'd like to show you, just go through some charts, and now just kind of show you kind of the more technical perspective. Just bear with me. I'm going to pull them up. I'm just going to, hopefully you can see this chart here, which is euro dollar. It is a hourly chart here. So as you can see, what this is showing us here is that you've got euro dollar testing the bottom of its most recent range, which is just below 134.50, so about 134.40. And it's actually been stuck in this range since for the past week. So the top of that range is then 135. So 135 being the high, 134.40 being the low. So essentially what this is telling us is that euro dollar at the moment is very weak within its range. Now we can see how weak it is, because here, as you can tell, it's below its key moving averages. Added to that, so it's been below for 1, 2, 3 bars. It's a big cluster of moving averages there. Added to that, on a short-term basis, you've also got the MACD turning lower here, and the RSI just confirming this move lower, and that potentially there is a bit more momentum. What the MACD is showing us, so it's a really good directional indicator, is that it certainly doesn't look oversold at this stage. So if we see continued bad news coming out of Europe or continued risk-off appetite in the market, then we could actually continue to see further downside, because there is more momentum to come. There could be more momentum to come. Now, just looking at the on a daily chart, change my lines here a minute. Oh, there we. I assume you can all see the euro dollar daily chart now. But as you can see, again, what we're looking at here is almost just a consolidation before we see another break lower. So there's a bit of a flag pattern happening up here, and we'd expect that to kind of break down, and then the next target level below here is about 131. So even though there's been some stickiness around this 135 level, as we can see on the shorter term chart, this to me is just dull stickiness here. That to me is just a resting place before we actually fall further and potentially retest those early October lows of 131. So essentially, the hourly chart, the shorter term chart, the hourly chart, and the daily term chart, which is more longer term in nature, are really both pointing to further weakness for the single currency. As one would expect, the single currency, the euro, does tend to underperform during periods of risk aversion, and during periods of risk aversion, the dollar does tend to see a lot of buying interest for obvious reasons. Now, I would like to pull up Euro Aussie. One thing that I have been tending to do is look at Euro Aussie because it's a great gauge of risk appetite. So Euro if you think of FX, the different various currencies on a spectrum, you essentially have the Aussie dollar at the most risky end of that spectrum. Then comes the euro, and then on the other side, on the least risky side of the spectrum, you have the yen and the dollar, because they're kind of seen as safe havens now. So, as you would expect, during periods of risk aversion, euro tends to outperform the Aussie, and that's exactly what we've seen. Now, we did see this level here, so kind of just below 137, was a bit of a key resistance level, but as risk appetite just drained out of the market, and we've actually seen it bust up above there. So it's at 137.70. Obviously, the next target is at this kind of 140 level, which it hasn't managed to sustain. But for as long as risk appetite remains off the table, if you like, or risk appetite is waning in the market, then we think this is going to be good news for Euro Aussie. Now, this is a daily chart, as you can see here. I'm going to look at the more shorter term chart, but I just wanted to show you these levels and how important they are. Obviously, 140 being a bit of a double top, so it potentially could go back to retest that 140 level. The MACD is also confirming this. So the directional indicators are also reaffirming the upward momentum for Euro Aussie. Now, on the hourly chart, which I hope you can see as well, running into a little bit of resistance here at 138, but overall, and we could actually see a consolidation pattern happening at this level. Let me just draw a line here. This is very, very short term, but potentially, obviously this 21-hour moving average, 137.50. Is a very key support level now. I'm going to take off that line. It doesn't really mean anything. So 137.50 is a key support, and that's the 21-hour moving average. So if we are to see a little bit of the euro have had a very large move to the downside, as I said, that 134.50 in euro dollar is a key level to watch for. And someone's just asked me about euro Aussie. Are they risk on? Actually what I said is euro Aussie tends to rise when risk is not on. But Euro and the Aussie are both at the risky end of the spectrum. But the difference is that the Aussie is more risky than the Euro. So I hope that's cleared up some confusion. So what we would expect in the current environment, where risk is off, if you like, or we're in a risk-averse situation whereby stocks are falling and treasuries, for example, are rising. We are seeing Euro Aussie actually come under a lot of quite upward pressure. So as you can see here, this is all risk aversion, this move here, and that purely the Euro does tend to outperform the Aussie during periods of risk aversion because it's less risky than the Aussie. So hopefully that's made some sense. And the reason why I wanted to bring this up to you is purely because if you're looking for a Euro cross, this is quite a nice one. There's certainly some levels out there, but as you can see, just on the hourly chart, we could be experiencing just a little bit of stickiness around this 138 level. Now, the other euro cross I wanted to look at was actually euro sterling. So euro sterling has been, let's look at the daily chart first, very much kind of stuck in a range. It bounced off these 85 lows here, which were one of the lowest levels since February, so for about 11 months, 9 months, 10 months, and rose and actually started to appreciate this week. As we saw, certainly yesterday anyway, a better tone to risk. However, today, during periods of risk aversion, we do tend to see euro sterling come under pressure. So we would expect, as you can see, there's some key technical indicators here, key technical resistance here at 86.50, which is the 55-day moving average on my chart. That's the green line on this chart. That looks like resistance for now. And if it's to fall back below 86, which is the 21-day moving average, then that could potentially target levels back to 85.50. So they're levels to watch in euro sterling. This is just the shorter term chart. And as you can see, the MACD's turned lower. So is the RSI. And we have seen this cross fall below its 21-hour moving average. But there is some support here at 86.20. So do watch out for that on the short term. Now, bear with me because I would like to show you a different chart. So as I said, I'm just going to bring it up. But as I said, obviously things in Europe are dominating things. I know there's going to be some technicians here who aren't going to be interested at all. But there is, bear with me, I'm just going to pull up this chart here. There are great. So hopefully what you see here is it's an Italian 2-10 spread. So it's a 10-year yield minus the 2-year yield. So it's a spread between longer-term yields and shorter-term yields, essentially, and they're Italian long-term and short-term yields. And as you can see, this fell into negative territory. So when this is moving downwards, what this shows is that 2-year yields, so shorter-term yields, are rising faster than 10-year yields or longer-term yields. And the reason why I bring that up, so those of you who've joined my webinars before will have seen similar charts to this, because I do like to bring it up. But when short-term bond yields are rising faster than longer-term bond yields, it really does show a lot of stress in your bond market. So what this is showing is that there is at the moment an incredible amount of stress in Italy's bond market. In fact, when this goes into negative territory, so as you can see, it's fallen to minus 25 basis points. So that means that 2-year yields are actually yielding more than 10-year bond yields, or 10-year bonds, sorry. That shows a fully inverted yield curve. Now, an inverted yield curve is incredibly worrying, largely because it tends to signal recession. So this is very bad news for Italy. It suggests that there's still a huge amount of stress. In the Eurozone crisis isn't anywhere near coming to any kind of conclusion at all. Obviously, the core economies like Italy, like Spain, have been dragged in, and added to that, you've obviously also got these growth fears. So, as I mentioned at the start, this really is a toxic mix for risk right now. We've got very bad news coming out from big economies out of Europe. We've got bad economic data coming out of China, and added to that, things in the US don't look fantastic either. Not only did we have a quite sharp revision lower in GDP yesterday for the third quarter from 2.5% to 2%, but we also have this wrangling up on Capitol Hill. So there's an awful lot of uncertainty in the market, and there's growth fears. And those two things will weigh on risk appetite, we believe. Added to that, you do also have to remember that we are in holiday-themed markets. Tomorrow is Thanksgiving in the US. Traditionally, the US are out Thursday and Friday, and actually start to kind of dwindle out today as well. So we could see some very, very choppy conditions because liquidity is so thin. Now, I'd like to show you a gold chart. So I'm just going to pull up my chart and then I'll show it to you. Gold has been such an interesting thing to trade. It's been one of the most interesting. Great. So hopefully now you can see my gold chart. This is a candlestick chart, and the reason why I bring it up, let me just annotate here, is because of this. I'm going to just zoom in at this level here. But if you look, the 50-day moving average has crossed below the 100-day moving average. So when shorter-term moving averages cross below longer-term moving averages, that is a bearish signal. But however, what we've actually seen is gold start to rise. Gold actually rise. So it's broken back above that 1700 level. But for me, the technical indicator at the moment is still pointing lower. This could be a false break higher. That's what the technicals are saying to us. Added to that, from a fundamental basis, there's not much there to support a stronger gold price, because over the last 6 months, it has not acted as a safe haven. It's moved in line with risk appetite. It's had a stronger correlation to the S&P than it has to something like the yen. So it really has. It can't be considered a safe haven at the moment. And just this technical indicator here with the shorter term moving average crossing below the longer term suggests to me that there could be further weakness in store for gold. Now, we're not seeing it right now. But if we were to get back to, say, that kind of 1227 level, 1250 level, then that potentially would be, that there could be some selling pressure coming in there. Now, I'm just going to zoom out again. But as you can see here, the gold has very much been trading in a range for the last 3 months, with 1800 being the top and 1600 being the low. So if this 1700 break above 1700 is a false break, then potentially there is very, very good support there at 1600, which is also the 200-day moving average. Now, I'm going to show you another way of looking at the euro as well. Just bear with me one moment. Great. So you should be able to see my point. The chart in front of you is a point and figure chart. I really like point and figure charts. Each little box represents a price. As you can see, those of you who haven't used them before, you might be thinking, hang on a minute, the date or time is missing on this chart. Well, actually, no, point and figure strips out charts. So what you see is pure price, which actually is why I like it. Now, this is a long-term chart. This shows price movements over the past year, essentially. But what you look for in point and figure charts is levels. So you look for kind of support resistance levels. It's just a very good way of seeing trend clearly. It strips out the noise, and it can also help you target kind of levels to watch. So one thing I would note, just from looking at this chart, so from kind of going kind of left to right, if you like, is that euro peaked just below 150, and right now over the last 12 months, euro is looking very weak within its yearly range. So as you can see, it's kind of here at 134.50. This 134.50 level is a really key support level. If it breaks below here, then we have to target kind of this area down here, which is about 131.50, 132. That's the next level to target, and then below there we're looking at 129, which is the low reached at the end of May. So we saw that break below 130. But right now, if we do have a sustainable break below 134.50, then we would then target kind of 131.50, 132, and then below there and after that 129 would come into view. So a break of that really key psychological level 130. But what you really have to what this is really showing us is that the euro is very weak against the dollar right now. The dollar is looking very strong. The euro is at a very vulnerable level at this 134.50. Now, it's managed to hold it before, but the fact that it's testing it again suggests to me that it could weaken this time, and then we would target this 131, 150, 132 level, as I mentioned before. So this is just another way of looking at price and looking at trend, but I quite like it because it kind of gives me a clear sense of where the euro is going. Now, I will just talk about one other thing before we move on, and I take some questions. Bear with me, I'm just going to pull up my chart. Sorry, my machine is incredibly sensitive today. So hopefully you can see this chart here, which is Aussie yen. The reason why I show you Aussie yen is because it is the ultimate risk barometer. And if we're going to be in for a sharp period of risk aversion, maybe today, the next couple of days, then you will definitely see it in Aussie yen. So it's a great way to see what the market's doing. So this is the daily chart. So as you can see, pretty much for most of this month, it's been on a tear lower. I mean, that is a kind of a beautiful trend, if you like. You don't always see that, but you do often in something like Aussie yen, because essentially what you're doing is you're going from, as I said, looking at FX as a spectrum. You're going from the really risky end, which is Aussie, to the very safe end, which is yen. So that's why I consider it a risk barometer. So as you can see, it's testing this 75 level here. Looking at the shorter term chart, as I said, now there has obviously been a very sharp move lower, yesterday or earlier today during the Asia session. Now we could see a little bit of stickiness around the 75 level in the same way that we could see some stickiness around that 134.50 level. In fact, what we've seen is a euro dollar actually kind of just oscillate around on that 134.50 level between 134.40 and 134.60. And we're seeing something quite similar here. So we're seeing this kind of oscillation around the 75.20 level. So there could potentially be a bit of stickiness before around 75 in Aussie yen. But if we continue to see, so as you can see here on a shorter term basis, both the RSI and the MACD still don't really tell us too much. It's just we could go sideways for a little while before kind of embarking on the next leg lower. But this pair is really driven by the fundamentals. So if the fundamentals continue to come out very weak, growth fears, Eurozone fears, then you would expect to see further weakness in the Aussie yen. Now, someone's asked me to look at sterling, which I'm very happy to do. Bear with me, I'll pull up my chart. I'm going to look at cable first. We obviously did look at euro sterling. Now, euro sterling is a very choppy cross, largely because, as I said, it moves very much on risk appetite. Sterling, again, has come under pressure too. As you can see, it's looking very weak. It's on a short-term basis. It's below all of its major moving averages. It's finding a little bit of stickiness at 55, just below 56. So at 55.80, it's kind of gone down, tested a little bit lower. But the one thing I would point out is that this MACD has turned lower, and the RSI is also pointing lower. So yes, we've traded sideways between kind of 156.50 and 155.70. So we've been in a very kind of tight range for the last few days, but potentially we are weak within that range right now, as you can see here. And we think that if risk appetite or stocks continue to do badly, just get rid of that other line, just confusing things. So as you can probably gather, I like kind of my charts to be quite clean. I'm not one full of lines and everything else. I like candlestick charts, and I also like kind of cleanish lines. So that's how I look at the markets anyway. But again, below this 55.80 level, I'm then going to move on to the daily chart, because below here you're then targeting kind of 154.50. So that is certainly, it's looking incredibly weak, sterling. So this is cable, so sterling versus the US dollar. It is looking very, very weak within its recent range. Again, that break below 157.70 really has just seen sharp decline this week in the pound. And as I said, below here does open the way to 154.50. Now, someone's asked me to look at Swissy. So that's dollar Swiss. Again, dollar Swiss is such a strange one. Now I'm going to show you the daily chart first, so the slightly longer term chart first, purely because, again, this has really been affected hugely by intervention by the SNB. So as you can see, the dollar has strengthened dramatically, 20 big figures since August, since the SNB started doing intervention. So from a technical perspective, it still looks like it's in a nice uptrend on a daily basis. As you can see, MACD and RSI kind of turning over a little bit, which are kind of being reflected in the price action here. So we could move sideways for a little bit longer. But remember, this is a very, very difficult cross to trade because of the risk of SNB action if the Swissy is to strengthen. Now, just looking at it on a daily basis, so what we've seen here, again, really testing a key level here. So as I said, the daily MACD is turning over just a little bit. We've seen a little bit of sideways movement, a little bit of weakness in dollar Swissy right now, but it's currently testing a really, really key support level at this kind of 91.30 level, which is also the convergence of the 21-hour and the 200-hour moving average. Now, looking a bit shorter term than that, so looking at the 30-minute chart, again, it's kind of managed to hold above this kind of 91.20 level, which suggests that that it certainly will start to respect the support levels here. The one thing that we would be careful of is if the 21-hour does cross below the 200-hour. It doesn't look like it is at the moment. They're kind of both converging, and actually the 21-hour looks like it's moving slightly higher again. But if that was to cross below the 200-hour, that would signal further weakness. But as I said before, if it does break below this 91.20 support level, then it opens the way to 91, and then obviously you've got to target the lows of kind of around 90. Obviously, traditionally, the Swissy does tend to appreciate very strongly, especially during periods of risk aversion. So that would be quite a normal thing to expect. However, with the Swissy, there's also this other element that you need to consider, which is obviously the SNB. And the SNB has been very, very vociferous and actually very good in being able to limit Swissy support. So that is certainly something to watch out for there. Now, I'm happy to take another couple of questions. The one thing that I would mention, certainly for sterling today, so as I said, looking back at that sterling chart, testing that real key level at 57.70. It's looking very weak to me. It's below all of its major moving averages. As I said, the MACD and the RSI have turned lower. But we've also got minutes of the Bank of England's latest meeting out at 9:30. That is, they're not as important as normal, purely because we had the inflation report last week, which suggested that there's so if you have so basically the Bank of England minutes are out at 9:30, so you do need to watch them. They are probably likely to be sterling negative. Now, some of it will obviously be priced in, largely because the reason why is because we had the inflation report last week, so we do expect more QE now. However, it could cause a little bit of a kerfuffle in sterling at about 9:30, and if you see that, then that's probably because of the release of the minutes, which may just add to downward pressure on sterling anyway. But we do think that sterling is going to continue to move risk appetite rather than move on its own fundamentals. Now, someone said, when we see that a pair is very weak, there should be a trend reversal at some point, and how can you identify the chance of a trend reversal? So, for example, in euro-dollar. Well, let me just put out the euro-dollar chart. I mean, the way to look at kind of reversals and things like this is that there should be a key reversal. Well, yeah, but sometimes that doesn't always happen. I mean, at the moment, as I said, we're very much within a range. So when you're in a range, you wouldn't look for a key reversal. Now, where you might, depending on the outcome, is at this level here. So below 131, below 130 at about 129. That was the last time that we saw it. We then saw this uptrend, then we saw this downtrend. So this is going to be a really key level. Basically, if we don't see a reversal then we're probably going to be targeting 125. So the way that you look for kind of reversals, I tend to look at the directional indicators like this MACD here. So as you can see, just going, actually you might not be able to see this chart. Let me just double check. Hopefully you can see this chart here. We'll just get rid of that line. So as you can see here, the MACD, so your directional indicator, hit a real low. So it looked very, very oversold. And it did bounce back from below 130. And as you can see, you can trace that all up there. Again, at 150, it looked very overbought, so it fell again. Kind of moved sideways really since then before embarking on another fall. We then got down to near 130 and it kind of bounced back again, and now we're looking lower again. So it's really kind of, the key reversals tend to happen certainly in FX. Number one, very quickly, but also when you've got kind of overbought and oversold conditions. So as I said earlier, you've really got to look at this one. If we do get a convincing break below 134.50, which we think we will, we think that this 135, 134.50 area is just a real resting zone for euro dollar. Then we would absolutely target 131.50. That could be potentially where there's again a bit of a reversal, because it could have gone a bit too far. It's a very key support level. This 130 level is respected in the market, so that could be where your reversal is, as we saw back in January. So below 131, below 130. So we saw that in January when it got down to kind of just above 129. So there are levels out there that the market respects. So it's a very good question. And it's kind of a lesson to us all. As I said, there are lessons. There certainly are, that 130 level is such a key psychological level for euro dollar that it will be respected by the market. And so all traders should respect it as well. But certainly in the very near term, euro dollar is looking fairly weak. But it's trading, and as I said again, this week, traders, be very, very careful. We are in very thin volume. Our markets are trading in very thin volumes. And they also are prone to very large moves, as we saw yesterday. So, just today, the range for euro dollar has been close to 100 points, and that's just today. Now, someone's asked a key reversal point for sterling, and that's going to be my last question. I don't mind taking that very quickly. With sterling, as I said, this kind of 153 mark and then 150. So you always need to look at the big levels. As I said, this kind of 153.50 level was respected in early 2011, and it was respected again in September, during the lows in September. So one would expect that to be respected again, and that's certainly a key level. Now, obviously, kind of double bottom, If we are to test it again, then it could potentially be actually signal further weakness. But right now, whenever sterling tends to get oversold, it does tend to bounce back, obviously, as one would expect. But whether or not that's temporary, so what one would expect is that it will start to look oversold at 153.50. We could see a bit of consolidation there, so a little bit of strength in sterling. But then obviously if the conditions are right, it could also go weaker from there. So do watch out for that. But that's it from me today. Thank you very much for listening. Please join me on Friday, and good luck trading. And if you're in the States, then enjoy Thanksgiving. Thank you.